Across more than a decade, Bitcoin has survived some of the most dramatic market crashes in financial history. Each collapse shaped the industry and revealed what crypto is truly made of. From the earliest days of hacking scandals to global financial panics, these are the events that tested Bitcoin's resilience, pushing it to the brink, yet never managing to break it. This is the story of its greatest crises, the moments that defined its journey, and the lessons learned from the digital ashes. Let's begin in 2011, a time when Bitcoin was still a fringe experiment. The dominant exchange was a platform named Gox. In June of that year, the market experienced its first true shock. A hacker, having gained illicit access to an auditor's account, placed a massive sell order, dumping thousands of stolen coins onto the market for just pennies each. The result was a cataclysmic flash crash. In mere minutes, the price of Bitcoin plummeted from $17.50 to a fraction of a cent, a collapse of nearly 99.9%. Trading was halted and the event was rolled back, but the damage to public perception was severe. It was a brutal lesson in the fragility of early crypto infrastructure and the immense risk of centralized points of failure. The incident served as the first major warning that in this new digital frontier, security was not a feature, but a necessity for survival. 2 years later, in April 2013, Mt. Gox was again at the center of a crisis. By this point, Bitcoin had staged a remarkable recovery, soaring to a new high of $266. The market was euphoric, and mainstream interest was growing. But just as quickly as it rose, it fell. The exchange was hit by a massive distributed denial of service, or DDoS attack. The platform froze, overwhelmed by a flood of traffic. Traders were locked out, unable to buy or sell, and panic quickly set in. With the market's primary liquidity hub paralyzed, fear took over. Within hours, Bitcoin's price collapsed by over 58%, dropping to $105. Although the exchange eventually came back online, this event, coupled with the previous hack, further eroded trust in Gox and highlighted the systemic risks posed by a single, dominant exchange. It was a clear signal that the ecosystem needed to decentralize not just its technology, but its market infrastructure as well. Fast forward to 2017. Bitcoin was in the midst of an unprecedented bull run, fueled by a frenzy of initial coin offerings, or ICOs. Startups were raising millions by issuing their own digital tokens, and speculation was rampant. The market was overheating, and regulators were taking notice. In September, the People's Bank of China declared ICOs to be an illegal form of fundraising. It went further, ordering all domestic cryptocurrency exchanges to cease operations. The news sent shockwaves through the global market. China was, at the time, the dominant force in crypto trading, accounting for a huge portion of the world's volume. With its doors suddenly slammed shut, a wave of panic selling ensued. Bitcoin's price tumbled from over $4,400 to below $3,300 in just 2 weeks, a drop of nearly 40%. This event marked the first significant regulatory crackdown by a major world power, and it demonstrated how quickly government intervention could rattle the entire crypto market. The market recovered, and by December 2017, Bitcoin was on a parabolic surge, rocketing towards its then all-time high of nearly $20,000. Mainstream finance was finally taking it seriously, so much so that two of the world's largest derivatives exchanges, the CME and CBOE, launched Bitcoin futures contracts. This was seen as a milestone, a bridge connecting the Wild West of crypto to the established world of Wall Street. However, the introduction of futures trading had an unexpected effect. It provided a straightforward way for institutional investors to bet against Bitcoin, to short the market. The euphoria peaked on the very day futures went live. What followed was not a further surge, but a brutal correction. In the weeks that followed, the price collapsed, falling from over $16,500 to just over $11,000, a 33% crash. Many analysts believe the launch of futures marked the top of the 2017 bull market, providing the tools that allowed bears to finally tame the seemingly unstoppable rally. The next major crisis came not from within crypto, but from a global catastrophe. On March 12, 2020, a day that came to be known as Black Thursday, financial markets around the world melted down in response to the escalating COVID-19 pandemic. Stocks, bonds, gold, everything was sold off in a desperate dash for cash. Bitcoin, which some had hoped would act as a safe haven asset, proved to be anything but. In a single, brutal 24-hour period, it suffered one of its worst ever single-day losses. The price crashed from nearly $8,000 to a low of $4,850, a drop of almost 50%. The sell-off was so severe that it triggered a cascade of liquidations on derivatives platforms, compounding the downward spiral. It was a stark reminder that in a true global panic, all correlations go to one, and even digital gold is not immune to a worldwide flight to safety. A year later, in May 2021, China was once again the catalyst for a market-wide downturn. Having already banned trading, the Chinese government turned its attention to Bitcoin mining, a sector it had long dominated. Citing environmental concerns and financial risks, authorities launched a sweeping crackdown, ordering mining operations across the country to shut down. This move effectively dismantled over half of Bitcoin's global hash rate, the network's total computing power. At the same time, a seemingly unrelated event added fuel to the fire. Elon Musk, whose company Tesla had previously embraced Bitcoin, announced that it would no longer accept it as payment, also due to environmental concerns. The combined impact of these two events was devastating. The market was spooked by the regulatory onslaught and the negative sentiment from a high-profile supporter. Bitcoin's price plunged from $43,000 to as low as $30,000, wiping out over 30% of its value in a matter of hours and ushering in a multi-month bear market. The market turbulence continued into 2022. By June, the global economy was struggling with high inflation and rising interest rates, creating a difficult environment for risk assets like crypto. This backdrop set the stage for a crisis of leverage and credit. The first domino to fall was Celsius, a major cryptocurrency lending platform that promised users high yields on their deposits. On June 12th, Celsius abruptly announced it was freezing all customer withdrawals, swaps, and transfers, citing extreme market conditions. The news sparked immediate fear of insolvency and triggered a wave of contagion across the crypto lending space. With billions of dollars worth of customer funds suddenly locked up, trust evaporated. Bitcoin's price, which was already under pressure, collapsed further, falling from around $26,000 to below $22,000. The Celsius freeze was the first major blow in what would become a devastating credit crisis for the industry. The final, and perhaps most shocking crash of this period came just a few months later. In November 2022, FTX, one of the world's largest and most trusted cryptocurrency exchanges, imploded in spectacular fashion. Revelations of financial mismanagement and the commingling of customer funds with its sister trading firm, Alameda Research, led to a bank run on the exchange. Within days, a multi-billion-dollar hole was exposed in its balance sheet, and the company filed for bankruptcy. The downfall of FTX was a seismic event. It was not just an exchange failing. It was a betrayal of trust by one of the industry's most prominent figures. The contagion was immediate and brutal. Bitcoin's price crashed by over 17% overnight, plunging from $20,500 to below $15,600, hitting a new two-year low. The FTX collapse represented a deep systemic failure and left a scar on the industry that is still healing. Yet after every hack, every ban, every panic, and every collapse, Bitcoin has not only survived, but it has returned. The crash of MTGOX led to better exchange security and the rise of decentralized alternatives. The regulatory crackdowns forced the industry to mature and engage with policymakers. The leverage-fueled collapses of 2022 exposed unsustainable business models, forcing a painful but necessary cleansing of the system. Each crisis served as a trial by fire, burning away the weakest links and hardening the resolve of those who remained. History has shown that volatility is part of Bitcoin's DNA, but it has also shown that with every crash, the network rebuilds, learns, and ultimately emerges stronger. History doesn't repeat, but in crypto, it often rhymes. Subscribe to Crypto Nexus for more deep dive documentaries.